We saw the market start to slightly recover yesterday after a few consecutive red days across the board, but one thing that we have noticed is Tesla continues to be in a downtrend, down 4% yesterday, and when we zoom out to over the last month, whilst it hasn't looked good for the overall S&P, again Tesla hasn't performed that great, one of the worst performing, down around 27%. Now we also like to point out that the average company in the S&P right now is trading significantly above its own 5-year valuation on a forward P basis, but one thing we can also highlight is that Tesla does trade very high, right now around 75, so there is a lot of expectation based on this company, and they have been suffering at least in the shorter term. In fact, earlier this month, we noticed it drop around 6% after BYD not only partners with DeepSeek, but we also get a lot of political issues around the CEO Elon Musk, as investors are starting to believe that Doge is becoming a distraction with him, as well as all of the issues that he does have with OpenAI in terms of his bid and just the ongoing feud with Sam Altman. We also saw, in fact, just a few days ago, the company coming below the $1 trillion mark, and we actually noticed something here that maybe has gone under the radar, but Reuters reported on Monday that the company's long-awaited upgrade of their partially automated driving system in China did leave their owners unimpressed. And one of the major reasons for the dip we have seen, at least in the shorter term, is that EU sales of Tesla vehicles are down around 45% in January, and that is quite interesting to note, not because the overall market is in fact also falling, actually quite the opposite. While sale of Tesla's vehicles is down 45% just on the month, this is in relation to Europe, the market for electric vehicles actually went the other way and was up 37% for the overall industry. And we can see here the growing risk of Tesla in terms of their core car selling business, especially when Elon Musk is having a lot of his attention elsewhere in politics as well as other areas. At the beginning of the year, we actually got to see Bank of America downgrade Tesla. They pointed out the high valuation as well as risk to the overall electric vehicle market and their own strategy. But what's quite interesting to note is even though that they did downgrade the company, they still raised their price target to $490. And remember, this was at a time where the company was trading fairly strongly. And this is what we always like to point out with analysts. When companies are looking very promising purely in terms of the share price, they will raise their expectations, but we wouldn't be surprised to see now the company below $300, a lot of analysts start to give downgrades or in fact reduce their overall price target. And some of the things that they did pinpoint about the whole company, there is execution risk very high, because if they are unable to come through on some of those long-term promises like the Robotaxi, like Optimus, and energy generation and storage, then that could really impact the company overall, and the high valuation that we're seeing this company trade for could really come down, but very, very drastically. Now, one thing we do hear about Elon Musk in particular is that he does typically tend to overpromise and underdeliver. It wasn't that too long ago, in fact in October, where he was talking about a $30,000 Tesla self-driving cybercab, as well as a larger robovan at the Robotaxi event that got investors very excited, and there was also a mention and in fact a show of Optimus robot. Now, whether or not that is something we do get to see in the time frame or in fact unravel and something that investors actually like and something that is used worldwide, this is all a lot of speculation that is really driving this company to such an incredibly high valuation. And we can see it is still up, however, 46% over the last 12 months. Year to date, though, they are now down 28%, and this is a company that does now trade in the mid to lower end of the 52-week range. Now, a lot of investors will have been in this company for quite some time. You can in fact see over the last 10 years, you would have massively outperformed the S&P, up 2,283%, but just look very volatile, bit of a roller coaster up and down. In fact, this company was trading at the beginning of 2023 at $113, and we can in fact see pretty much all-time highs near the $500 mark, slightly lower at the back end of last year. Now, all three analysts, something that we've actually seen for quite some time, do still believe this company is a hold right across the board, and we want to understand today, is there a possible opportunity here? Is there something the market is missing? And we'll run it through our own updated valuation, given they did have their earnings to close out FY24 just last month. Now the headline does give it away that they actually missed their most recent earnings and their revenue was down around 8%, but if we look at some of the headline numbers that the market does typically like to note, the EPS came in lower, 73 cents, market wanted 76. Their revenue also not looking good at all, 25.71, market forecasted 27.26. But also their revenue is up only 2% from the same quarter last year. That is well below the average inflation we typically want to see at 4%. That is just to keep up in line with real numbers. And specifically their automotive revenue was down around 8%. Their operating income also down 23% on a year-on-year comparative. And one of the main reasons they did talk about the decrease is they had to reduce a lot of their selling prices across a wide range of their models, Model 3, Model Y, S and X. But that isn't typically a great sign. It is showing that consumers are only looking to buy these products at a much lower price, which will ultimately not only affect their top line revenue, but also their margins. Speaking of, their bottom line also down 71% from the same quarter last year, 2.32 billion from the same comparative where it sat at 7.93 billion, and we can see their bottom line in a graphical basis looking very, very inconsistent. Now there will always be talk about the CEO, whether or not he has his fingers in too many different places, and as we can see, and in fact just since Donald Trump has become president, he does seem to be right across the news, and it doesn't really seem to be any chatter about Tesla. It is a lot more in the political space. So these are considerations you need to have. Always important to understand the CEO of a company you're investing in and whether or not you do align with his strategy and his movements overall. In terms of looking at the last 4 quarters for Tesla, they've missed on 3 of them, only beat 1. That is a 25% positive track record, and over the next 4 quarters, whilst they do anticipate growth to the EPS year on year, you have to question whether or not you believe that given their very poor historical track record, and based on the EPS of 285, this company now trades at a forward valuation of 102. A lot of expectation is baked into the company, and probably no surprises where we get a D- on the valuation space. The sector as a whole trades significantly lower at 16.4, meaning right now you are paying a 525% premium for Tesla overall, although in comparison to their own 5-year forward valuation, it does sit around 12% lower, and the conclusion does look to be reinforced no matter what valuation metric you look at today. Tesla trades significantly above the sector, in fact a very large premium, but slightly under their own historical figures. Now in terms of growth, they do get a B-, year on year, pretty pathetic, is only up 1%, sector is even higher at 2.6, their own 5-year average at 34%, significantly above. In terms of over the next 12 months, 11% expected, higher than the sector at 3.3, their last 5 years a lot higher at 33%, and in terms of the earnings per share over the next 3 to 5 years, expected to grow at 14.7%, which yes is above the sector at 11.10, but just look at their own 5 years, much higher at 48.5. Profitability, they do look promising at the A+. Gross margin, 18%, lower significantly than the sector at 38%, lower as well their own 5-year at 22%, and bottom line, 7.3%, above the sector at 4.21%, but below their 5-year of 9.3%, and the company does generate quite a significant amount of cash from operations, 15 billion, sector at 271 million, and it does look to be lower over the last 5 years at 10.5%, so they've been generating quite a significant amount, and it has only been increasing over the period. Now, how do they compare against others in a similar space, the automobile manufacturers? We have Toyota, BYD, Ferrari, very high quality company, as well as others. Over the last year, even with the drop we have seen, they are still looking promising, 46%, the second best performing. When we zoom out to over the last 5 years, they're up 460%, again, second best. And over the last 10 years, up 2,150%, the best performing, but very important to understand that past performance is not an indicator of the future, and we also like to reinforce their performance against the S&P, which Tesla has outperformed over the last year, outperformed over the last 5, and outperformed over the last 10. Question you need to ask is, can they continue to outperform over the longer term? Now looking at the institutions where they have 66% ownership, around 30 billion worth of sales over the last year. In comparison though, more than twice the amount of buyers at 70 billion, and the same to be said in the most recent quarter Q4, institutions have bought twice as much, so they do appear to be very bullish, at least in 2024. In terms of insiders, quite high ownership at 21%, 342 million worth of sales over the last year, and we also get some selling in 2025 at 117 million. Now we'll show you for transparency who these insiders are, but do remember we don't typically see this as a bearish signal. They sell for many reasons, personal and financial. Most recent, Kimball Musk on the 6th of February, selling 75,000 shares, netting around $28 million. Again, information is here for the other sales. Now, is it a high quality company? We can look at some of the underlying metrics. Free cash flow per share, we want consistent growth over the long term, looking very inconsistent, although growth anticipated over the next 12 months. Sales growth, this isn't something you would typically attribute with a company that has a valuation on a forward P of over 100, 1% growth in the most recent period. Very inconsistent over the last 10 years, but they have had some very strong years, as we can in fact note. And in terms of the numericals, whilst we will cover this in a bit, it has been very rapid. The only question is, at what point will they start to slow down? And is this just a blip that we have seen in 2024? They've also been diluting your position as a shareholder over the last 10 years. Now, not a massive worry if they can continue to outperform the S&P, but definitely some consideration to have there. And on the ROIC, where we do want to see 10% at a bare minimum, again, we do get a lot of inconsistency, although nice to see the last few years at least around that 10% point. In terms of margins, whilst we did compare it earlier on against the sector and their own 5-year, ideally we want to see efficiencies, that is margins increasing over time, a high quality identifier, not just revenue increasing, but also margins. Not something we can in fact note here, and also below what we would typically say as the minimum 16%. Free cash flow around the minimum 5% from 2019 onwards, and then we get to their net debt to EBITDA, which does look very promising, essentially showing us the strength of the balance sheet. These are the number of years it would take the company to pay off all of their debt, net of cash on hand. In fact, from 2020 onwards and over the next 12 months expected, it won't even take Tesla one day to pay off all of their debt. Now, we've already shown you their revenue growth over the longer period. As we did say, it has started to slow down, at least over the more recent years, but we want to understand, what does the bottom line net income tell us here, and is it a similar story to above, or do we get something a little bit different? And we can see a lot of inconsistency. In fact, they didn't turn a profit until 2020, but we can see there is no real trend with that top line, so unfortunately we can't say they are fairly consistent, at least in this point in time. Then a very quick health check, total cash versus total debt. Although we did already say balance sheet looks strong, cash has been increasing over the last 10 years, 1.2 million in 2015, now at 36.6 billion in that latest quarter. And we want to always compare it to total debt, both numerically and directionally, because one number here in pure isolation isn't going to give anything away. And their total debt looking fairly inconsistent, but increasing over the few years, 2.9 billion 2015, now at 13.6, their cash balance being higher, so as we said, balance sheet looking very strong. And we just also want to highlight the cash this company does generate from operations, a little bit inconsistent, but at least moving in the right direction on a trailing 12 month, now sitting at 14.9 billion. Now we're going to jump into the valuation of the company, but before we do, just to let you know, we have released our latest free weekly article. We drop one every single Monday morning to your inbox, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. Click below, you can sign up, read straight away, and gain access to 45 undervalued stocks for the month of February. Lots of information, upside that Wall Street themselves see over the next year. We will be releasing a March copy very, very soon. And on top of that, you can grab a recently released copy of 32 stocks that Wall Street themselves believe have the most upside right now in the S&P 500. So click below, you can sign up and read straight away. Now we have our updated valuation today with the intrinsic price at $203, derived from the DCF model. Now we'll show you how we got there with the free cash flow year on year. Very inconsistent, as we can see, going from negative to positive a number of years. Moving forwards, we've gone 35%, but as always, low, medium and high numbers are here. They are subjective, so you can always grab a copy of this model by clicking on the pinned comment below, writing to your own numbers, whether it is for Tesla or any others. That based on 35% and the discount rate at 8, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding. 203 then is that intrinsic value, meaning downside of negative 30%. Now, even if you're a lot more bullish and you believe with Robotaxis, with Optimus, and many other offerings from the company, 40% growth rate is applicable, still the intrinsic price is lower at $274, meaning downside of 6%. And full transparency will show you even at the 30% rate, $149, downside of 49%, meaning it's worth around half of its current value if you see them growing their free cash flows at 30% continuously over the longer term. Again, if you grab this spreadsheet, you can always input numbers if you believe way high at 45%. Then we have a value here of 368, but we're going to take through the medium rate at 35. And what we always like to do on this channel is at a margin of safety. We typically start off with 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data, and then we keep going till it's near the current trading price. But what we're already saying right now, we believe even after the drop Tesla has had, this company still looks to be overvalued, and we see it trading at a very, very significantly high premium. In terms of Wall Street, their price target at the moment is $350, so even with their hold rating, they still see 21% upside. But as always, give us your thoughts below. Is Tesla right now a buy, hold, or sell? Or in fact, do you believe it is a trap and definitely one to avoid? Don't forget, as always, to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon as well, where we do cover our weekly buys and sells. We have been making movements given the volatility, but as always, have a great day, and we'll see you all on the next one.